Amazing. We are live. I
Mhm.
will just wait maybe 30 odd seconds or so just to let people trickle in. But as you come in the meantime, please feel free to introduce yourself in the chat, say hello. Let's keep this social and be sure to switch your message to all attendees so everyone can see it. Right. Well, as we continue to kind of wait for people to come in, we can start. So without further ado, hello, Finimizers, and welcome to another Finimize live event. My name is Reda, an analyst here at Finimize, and I am really excited to host today's event on how to tap into your gold opportunity with our partner, GoldCore. Now, before we kind of get kick started, let's kind of run through some housekeeping rules. So first of all, like I said earlier, please, as you come in, feel free to introduce yourself in the chat. Tell us where you're tuning in from, and remember to switch the message to all attendees. Second of all, as you kind of come in, you're going to see a poll pop up on your screen. So please fill that in just so that we can get to know you better. And then third of all, this is the format is basically going to be a 15-minute discussion with our guest today, followed by a 15-minute audience Q&A, which takes me to my fourth and final point. Please use the Q&A box in Zoom to ask a question. And if you see a question that you like, please upvote it so it kind of moves up to the top. And that way we can go through the most upvoted questions first. So without further ado, let's kick off with our partner GoldCore. So if you don't know already, GoldCore basically helps you to protect your wealth in uncertain times. They're one of the world's most respected and client-focused precious metal specialist providers. Established in 2003, they're experts in the purchase, sale, and international storage of physical gold and silver coins and bars. They help clients of all levels, from small savers to institutional investors and family offices, regardless if they're new or experienced to gold investments. So if you're looking to protect your portfolio against the uncertainties that lie ahead, feel free to contact them today. Now, with that out of the way, I'm really excited to have GoldCore CEO with us, David Russell. So David is the CEO of GoldCore and is responsible for both the day-to-day management of the business as well as its long-term strategy. David joined GoldCore in 2008 as Director of Business Development and later took over as Director of Marketing and Communications. David, really excited to have you here. How are you doing today?
I'm really good, and I'm delighted to see so many participants from so many different countries. I'm looking at them coming in there. We've got them from the UK, we've got some from Ireland, which is great to see, and we've got them all the way over in the US as well, and a few other places in Europe as well. So it's great to have such a wide variety of people here.
Absolutely. And, it's a very exciting topic to say the least. I don't know how many times this year I've read the headline that gold prices have hit a new record high. So I'm sure it's very, very topical. And kind of with that in mind, I want to dive into some, questions. Maybe some people kind of know this, maybe they know some of the roles it plays or not, but maybe
Mm.
you can kind of be explain it all to us and maybe explain the various roles gold plays in an investor's portfolio.
Perfect. Well, just before we do that, I'll just show you. This is what we're talking about here. This is gold here. This is a British Britannia, 1 ounce Britannia, and that coin there is today in sterling is worth about £2,050. So it's an ounce of gold, an ounce of pure gold in that. So that's just kind of benchmarks where we are at this moment in time. And the question really is, why is it that people invest in gold? Why do they put it into their portfolio? Gold has been desired by humans for thousands of years. It's been part of the monetary system for thousands of years. It is primarily in this day and age, it has a couple of major roles. And the two major ones are it's a hedge against inflation and it's a hedge against uncertainty. Every time that we see headlines about the increase in national debt and you hear about money printing by central banks, gold tends to react. And the reality is the reason that is due to the characteristics of gold. Gold is very rare. All the gold that has ever been mined would fit into a cube about 20 meters square. That would fit into an Olympic swimming pool. It would fit onto the center court of Wimbledon. It's extremely rare. And it's that rarity and that finite nature that gives it a lot of its value, because it is effectively, it is controlled by nature. It's limited by nature, and it can only be, the amount of gold above ground can only be increased at the rate that you can find it, mine it, and refine it. And that's only at about 2 to 3% per year it increases. Now, if you compare that against what it is priced in, which is in fiat currency, whether that's sterling or euros or dollars, and that can be increased by central bank printing, government spending effectively. And that is under the wit and will of man. So if you have something that is limited in nature, priced in something that has unlimited potential for creation, when more money is printed, the price of gold goes up. And it's a hedge against inflation, because when more money is printed, the prices of general goods and services also go up. So in order to protect the value of your money, the value of your savings and your investment, investing in gold is something that has shown to have a strong correlation. The price of gold has a strong correlation with what happens in inflation. So when inflation goes up, the price of gold goes up. And now we've seen that for the last 20 years, gold has gone up by on average about 8% per annum, which has matched in some instances and outpaced the rate of inflation. So it's a great hedge against inflation. And the other key thing is it's a hedge against uncertainty. So whenever we have increase in geopolitical tension in the world, we tend to see gold respond. It has that safe haven quality. So there are very few things. There's nothing in your portfolio that simultaneously has the ability to be a hedge against inflation and a hedge against uncertainty. So therefore, it has a role in a portfolio. It tends to react to its price appreciates due to different triggers than what happens in the rest of your portfolio. So in a diversified portfolio, gold does really well.
Absolutely, it makes perfect sense. And I fully understand and appreciate those kind of relationships you're discussing where, one thing kind of goes up and, the price of gold should go up. But kind of leads me to a question I certainly get a lot, and I'm sure, David, you can answer it, much better, is, the question I get is, look, gold doesn't generate any cash flows. And, we've all been told in finance and investing classes, you value an asset by discounting its future cash flows, etc. So in light of that, how can you assign a value to gold, or what approach can investors take to actually determine gold's fair value?
Sure. So you can't use the same methodology with gold because it doesn't have a yield. And it not having a yield is one of its benefits, really. If you look at the things that do have a yield, you're talking about stocks, you're talking about bonds, you're talking about property, you're talking about cash in the bank. And you say, why is it they have a yield? They have a yield. Ultimately, they have a yield because you are dependent upon a counterparty in certain instances to perform a duty in order for that asset to maintain its value and return that income to you. So therefore, when it's investing in stocks and shares, the management of the company has to perform their duty. They have to take risks, and with that grow the business. And out of that, dividends are paid, and that's the return which you use to discount the cash flows. The same with bonds. When bonds are issued, the coupon on that is the premium. It's the interest rate you're going to use to discount future cash flows. Where does that come from? Well, that comes from the ability of the government to be able to manage the economy so that it can raise taxes in the future in order to be able to repay the principal and interest on those bonds. And it's the same when we look at property. Where does the yield on property come from? It comes from the ability of tenants to be able to continue to pay their rent. That's where that comes from. So again, you're dependent upon somebody to perform a task in order for that cash flow to remain. And the same then with deposits in banks. So where does that come from? It comes from the ability of the banks to be able to manage their assets and their liabilities, to be able to generate enough income to pay depositors for that money. So it is always somebody else's liability that you're buying. Gold is nobody else's liability. So it sits there. It's a rock. You dig it out of the ground over here and you put it over here, and it actually goes on a shelf and it does nothing. It does nothing. But its price responds when everybody else who is meant to be performing a duty and performing their task in order to be able to produce those returns to allow you to discount your cash flows, when they don't do their job, the price of gold appreciates. So it's a difficult thing to create, to use the same methodology to try and price gold, because there isn't that yield to do it. But what you're doing is, this is not about an investment where you say, I'm going to take 100% of my money and put it into gold. You want to have an allocation to gold so that when these people over here, for one reason or another, do not perform their tasks and their jobs properly, that you have something that in your portfolio is going to react positively to that and not negatively to that, to be able to smooth out the volatility that would be in your portfolio without it.
That's a really great way to put it, to say the least. Thank you so much for that, David. And then speaking about, gold prices, and I'm sure someone's going to ask this, but considering just how well gold has done over the past year, hitting record after record, what's your outlook on gold prices, perhaps, over the short term and perhaps over the long term?
Sure. We've, over the last year or so, we've seen a very strong run up in the gold price. Initially, that was primarily driven by a lot of central bank buying and a lot of central bank buying coming out of the East. And the reasons behind that are manifold. But effectively, what a lot of countries in the East are trying to do, a lot of governments in the East are trying to do, is they're trying to reduce their dependency on the dollar. We've saw post 2022 in the Ukraine invasion by Russia, rather, excuse me, that the US basically weaponized financial markets. And as a result of that, they took a lot of Russian assets and they seized a lot of Russian assets. A lot of other governments and countries around the world were looking at that and kind of said, well, if US disagrees with something that we do in the future, there's a chance that our assets would also be seized. So there was a large motivation to move out of dollar-denominated assets. We've also seen an awful lot of talk about the BRICS and the rise of the BRICS. And for those who don't know, that's Brazil, Russia, India, China. Looking to get together in something that kind of would resemble the Eurozone and the Euro. And there's a lot of talk of them potentially launching a new currency, and that currency being backed in large part by commodities, and in a large part of those commodities by gold. So there's been a lot of buying of gold by central banks to support and underpin these ideas. Now, gold reacts to uncertainty, as I said, and we have seen so much uncertainty over the last year, increase in uncertainty, whether that has been escalation of the war in Ukraine, whether that has been a dramatic increase in the tension in the Middle East, whether that has been tension between the East and the West, and also whether that has actually been a lot of internal tension in the US in the lead up to the election. So most of that hasn't gone away. The one thing that has gone away recently is the uncertainty around who's going to be the next president of the US and who's going to lead the next administration. That uncertainty has gone away. And as a result of that, what we've seen is the gold price retreat a bit. When the inauguration happens and a lot of these new policies get put into place, we're going to see how effective that they are. Our view is that ultimately it's very difficult at this stage, practically impossible to solve a lot of the economic problems that the US has at this moment in time, that the de-dollarization movement is going to continue. The rise of the BRICS is going to continue. The geopolitical tension is going to continue, although it might de-escalate in certain areas. There are other hotspots that are starting to boil over now. So all of this actually plays into the gold price. We see a continuation of that uncertainty because of the various different economic policies and the fact that ultimately that the national debt in the US is totally out of control, and it is very difficult for them to get that back under control, that there are going to be some very strong inflationary pressures coming on in the US as well. All of these things are going to underpin a higher gold price long term, although we do see that in all of these long-term bull markets, you do have some strong and steep pullbacks, and that's what we're seeing temporarily at this moment in time. That actually offers a lot of opportunities for individuals.
Amazing. Thank you so much. And one kind of final question to you before we move on to the audience Q&A. David, at the start, you pulled out, a coin I'd love to get my hands on. You showed us a nice physical gold coin. And what I wanted to ask you is, you can invest in gold like that through physical coins and bars. You can buy ETFs, you can buy futures, you can buy
Yeah.
gold miner stocks, etc. Can you kind of walk us through what are some of the pros and cons of all the different ways you can invest in gold?
Sure, sure. And there's actually a chart on the landing page that anybody on this webinar can have a look at. Rather than answer that in a way that has no context, what I tend to do is I look at it in terms of proximity to gold. So as I showed you, I showed you a coin there, and that's the Britannia there. I also have a 1 ounce gold bar here as well. Um, what I normally do in answering this question is I talk about the idea of proximity to your gold. All right. So how close are you to your gold? So if we just set the two ends of that continuum, and on the end where you are the closest to your gold, it is when it is here in your hand. You can't get any closer. That is taking physical delivery of coins and bars and storing it somewhere in your house. Now, some people like that idea. Some people want to be that close. On the very, very far end of that continuum, we've got investing in gold futures. Now, investing in gold futures is ultimately it's investing in a derivative. It's something that derives its price from something else. In this instance, a gold future derives its price from the underlying price of an ounce of gold. Now, investing in a future is not for the faint-hearted because it's akin to betting on the Grand National, effectively. It's a leveraged bet on the gold price. You do not own any gold. You do not take delivery of any gold. What you have is you've just got effectively a contract that if the price of gold goes up, you're going to earn money on that. If the price of gold falls, it's going to cost you. So that's the two ends of the spectrum. And in between that, everything else kind of fits, right? So you might look at mining stocks and say, well, I want to invest in gold, so I'll invest in mining stock. Well, when you're investing in a mining stock, you're not actually investing in physical gold. You're investing in a group of people who form a company who go out and prospect for gold and mine for gold. Now, there are millions and millions and millions over the years of miners who've gone out there, prospectors who've gone out there, not found anything, not been able to take what they found and mine it and refine it. It is highly speculative, and you don't own any physical gold. You own a share in a company that is mining gold. If the price of gold goes up, yes, there is a good chance to get a leveraged return on it, but companies are also then subject to all of the inflationary pressures that send the gold price also put up the cost of mining gold. So therefore, what you'd have seen over the last year to highlight this point is that while the price of gold in sterling terms has gone up by about 25 to 30% over the last year, gold mining stocks have barely moved, and a lot of them have actually fallen because underlying there's a strong inflationary pressure going against their cost base. You can move back, and there are other ways of doing it. You can look to digital gold, so you can invest in gold online. That is, an individual company will manage that for you, but the risks involved in that. You have a single point of failure because your gold is held by an individual company. You deal with them online in a digital fashion only, so there is technological risk there as well as the single point of failure from the corporate side. There is also then you can buy gold, physical gold like this, and have it stored with a company such as ours. We utilize a network of vaults throughout the world. They are not ours; they're a third party, so they are independent, specialized vaults with high levels of insurance and audit control over all of these things. So it's all about proximity. So if you are if your sense of the level of uncertainty in the global economy and financial markets is extremely high, you want to have your gold closer to you. In more benign times, you can invest in, let's call it, more risky ways of holding gold.
Makes perfect sense. Thank you so much, David, for that. And without further ado, I want to move on to the audience Q&A. The most upvoted question is actually one you've already answered, basically about the benefits of owning physical gold over, the other methods you discussed. So second most upvoted question comes from Bruno. In what scenario could gold's value completely crash?
Yeah. Gold won't always have the same value, but it always will have a value. Will it crash? It's unlikely to crash, totally crash, as the questionnaire puts it. One thing that kind of underpins it is the what we kind of alluded to there, which is the cost of mining gold. The mining gold is becoming increasingly more expensive. First of all of the easy gold that there has been found. Now, in order to mine gold, they are deeper mines. The concentration is not as good as it used to be, so it's more expensive to actually find it. But then actually to get it out of the ground, it's incredibly fuel intensive getting it out of the ground. So therefore, when we see an increase in oil prices, it dramatically increases the cost of getting gold out of the ground. And those companies are subject to all of the other inflationary pressures. So that kind of puts a floor under the gold price. But ultimately, what would cause the gold price to crash would be this. It would require fiscal discipline by governments. They've struggled to be able to do that over the last number of decades. It would require a reduction in geopolitical tension across the world. We want to move towards a much more peaceful world. We would want to have a situation where, leading on from that fiscal discipline, that deficits were got under control, national debts were got under control. So therefore, what you're looking for is kind of periods of deflation where there's a contraction in the money supply. So if we're measuring this thing against an ever-expanding money supply, the price of this is going to go up. If we're able to get that under control, pay down national debts, reduce the money supply, the price of gold will come down. But the chances of that happening at this moment in time are extremely low.
Amazing. Thank you. And we have another question from Bruno, who's really here to test the gold bulls today, because he's asking, what would happen to the value of gold if suddenly we found 1,000 tons of it in nature?
If you suddenly found 1,000 tons of it in nature, that would make its way into the gold supply, and yeah, it would have an impact on the gold price. It would fall. That's unlikely to happen though.
Thank you. And then we have another question from Magdalena. I am curious about the decrease in the price of gold over the past 2 weeks, which some people are saying is the biggest since the 2020 pandemic crash. So two questions. Is gold currently due for a correction? Second of all, what ETFs can serve as an alternative for investors to hedge against inflation?
Sure. Okay, let's say so. Over the last 2 weeks, we have seen a reduction in the gold price. If we go back to the two major drivers of higher gold prices, which is inflationary pressures and uncertainty, we have had a massive amount of uncertainty this year. We have seen in the last couple of weeks, we've seen a reduction in that uncertainty. There was Before the election, there was fear that this was going to be an extremely tightly contested election. It didn't turn out to be that way. And there was fear that if it was a tightly contested election and that there would be fraudulent claims and the such like, that this could lead to a lot of trouble, a lot of uncertainty as to ultimately who would be the next president, and a lot of implications for the US economy, economically and socially, actually. The election of Donald Trump by a significant margin removed a lot of that uncertainty. So temporarily, we are seeing a move lower in the gold price on the back of that. It is yet to be seen then, as I say, post-inauguration and implementation of new policies, what happens next. But all of the pressures that we talked about, all of the inflationary pressures, all of the financial pressures, all of the geopolitical tension, the de-dollarization, the rise of the BRICS, that is all still there. These things don't go up in a straight line, and people will know that from every single investment that they have. They don't go up in a straight line, because you'll have people that are short-term investors and people that are long-term investors. So those that are short-term investors and they see advantage, take a short-term profit, will take that short-term profit. That doesn't mean that the long-term bull market now is broken. Long-term bull market, we believe, is still intact and will be for a good number of years. There was a follow-up question there, so I want to make sure that I answer that. There was a second part to that.
What if there are any other ETFs that retail investors can consider to mitigate the risk of inflation? So I'm guessing not specifically gold related, but any other ETFs or asset classes that could act as an inflation hedge.
Um, I'll comment really only on the precious metals ETFs. Outside of that, not my area of expertise, so I won't comment on that.
That's fine, thank you. And then we have a question basically asking if someone were to buy, physical gold through your platform, A, can you store it on their behalf? And B, are they able to sell it back to you in the future?
Absolutely, to both those things, yes. We store it on behalf of clients. We utilize third-party vaults across the globe. They are in the UK, they're in Ireland, they're in the US, they're in Europe, they're in Singapore. So we have we've global coverage on that. They are independently audited. So there's an independent auditor that comes in each year to make sure that what we say is stored on behalf of clients is stored on behalf of clients. They are independently verifiable by the client themselves. So what I mean by that is they can actually log directly onto the vaults system and see the precious metals that's held against their sub accounts. And yes, we make a two-way market in it. So we guarantee to buy back anything that we sell. We do a lot of two-way business. We've been in business now for over 21 years. It's our 21st year this year, actually. So we have a lot of two-way business.
Amazing, thank you. And then we have another question basically asking you to kind of sum up sentiment towards gold today. Are people feeling, bearish, bullish, or kind of neutral?
That all depends upon their time frame, as a frame of reference. Long-term people are still extremely bullish. We saw such a strong run up pre-election that a pullback is expected. Whenever you see something that starts going like that, the pullback is always quite sharp. Long term, though, as I said, because of all of those fundamentals that underpin the gold price, the uncertainty, the de-dollarization, the geopolitical tension, the inflationary pressures that are there, long term, people are still bullish in gold. We believe this is very early stages of the bull market.
Thank you. Then we have a question basically asking what advice you would give to someone just starting out investing, particularly in gold. Is there a mistake you wish you'd avoided early on in your career?
That's a great question, and there are some basic things that everybody should know. And again, this 1 ounce bar that I showed you, that's 1 ounce. Now we sell gold in 1 ounce formats, 10 ounce formats, kilo formats. Depending on how much that you have to invest, one of the important things to think about is the concept of divisibility. A kilo of gold bar, it's about 32 ounces, right? And at this moment in time, that's about, call it 65,000 pounds worth, okay? And if you had 65,000 pounds and you bought a kilo of gold, that's great because you've got a larger format size. The premium on that will be slightly lower, so it's efficient from that point of view. But when you come to realize some of your profit in that, you can't, because you would have to sell the entire bar. So the concept of divisibility is really important. So depending upon how much you're looking to invest, you want to be able to sell off a portion of that. So therefore, if you had 65,000 to invest, you would be much better investing in, say, 32 1 ounce gold bars than 1 kilo of gold. That's a really important thing. I have a number of coins here. So there's another coin there. Let it get into focus there, if it will. There you are. That is an Austrian Philharmonic. Beautiful, beautiful coin. I have a Krugerrand here as well. So there are lots of different types of coins. Okay. Some of these are slightly more popular and more recognized. That Krugerrand there is probably one of the first really bullion coins, internationally recognized bullion coins. Some of these are highly recognized, particularly the the Britannia here. There's 1 ounce Britannia, which has actually come into focus there. There we are. Actually has a number of security features built into the coin. Maybe you can catch that just in the bottom corner. You can see there's a little holograph there. I tilt that. So there's a number of security features in these coins. Buying highly recognized bullion coins. So these are investment grade bullion coins. These ones here are most of these are 3 9s, 4 9s, which means purity is about 99.9%. Okay. There's some different variations, but I won't take too long to answer the question by going into those. Buying highly recognized bullion coins is always a good investment. Avoid things like collectibles. So you'll get these special commemorative coins, or you might find that people are selling a Star Wars coin, or the highly collectible ones. They'll have very, very high premiums on them. And they're premiums that you won't be able to realize when you go and sell them back into the market. So if what you're doing is to buy gold to get the most bang for your buck, to get the most gold for your buck, you want to be buying the popular format bullion coins and bars. They're the ones that you'll find at the lowest premium on them. They're the most liquid, they're the most recognized, so therefore the most easy to sell back, because ultimately, yes, we buy back from people, but we don't want to be the only people that they can sell to, because that then loses some of the benefit from them. So like, you can sell this Britannia to any one of thousands of dealers around the world. And that's what makes it highly liquid, because you don't want to be dependent upon just one place to be able to realize your investment.
Makes perfect sense. Thank you so much, David. And I'm afraid that's all the time we have for today. But just before, let you off, David, and everyone, just 2 very quick plugs. First of all, please don't forget our biggest event of the year. It's less than 3 weeks away, and you can register for your ticket. And of course, I'm talking about the Modern Investor Summit. So it's a 2-day event over December 3rd and 4th, and it's packed with back-to-back sessions and workshops led by the biggest names in finance. And it's your perfect opportunity to elevate your investment knowledge and network with fellow retail investors. The agenda is live, so register for your free ticket using the link shared in the chat. Second of all, finally, as you leave the event today, a pop-up survey will appear on your screen. Please take a few minutes to let us know what topics you're interested in hearing about in the future. David, on behalf of myself, Finimize, and the entire community, thank you so much. Your insights were extremely amazing and extremely valuable, and I loved all the physical coins you showed us. I can't wait to get my hands on some myself.
Thank you, Retta. Really appreciate it.
Thank you very much. Thank you, everyone, for joining us, and I look forward to seeing you at another event. Thank you. Bye-bye.